Alrighty. Doc here from North America. Good morning, good afternoon, and good evening. It is September 11th. Yes, indeed. For some, it's already Friday evening. For us traders here in the States, we just look back at the situation that happened 19 years ago, and then, they're doing all kinds of different events at the moment. Aaron's calling. There we go. And what's up there? Let's find the euro. And so today we were going to discuss options again. We're going to look at all the products and talk about options. And yesterday I realized that I was ridiculing the financial industry again as usual, and thought about it for a second there towards the end of the webinar, and thought, wow. There's only 5 option words. If you learn those 5 words, what they mean, that resolves pretty much most of understanding options, which is an incredible thing. And I guess the 5th one, I'm going to go through the 5 that I think is the most important thing of all, and that is that. Oh, you know what? I don't have the chat line up. Let me put the chat line up. I just looked over to see if anybody's saying anything and realized it's not there. And there we go. So, yeah, we're going to talk about the 5 words that seem to terrify people from utilizing, options. There we are. Oh, there we go. I see Juicy's up there. Hello. TGIF to you too. And September 11th, no doubt. We're going to talk about options a little bit more today. Try to be focused in on that. So the 5 words that I have to say basically is call. That's 1. Put is 2. Strike price. Let's see, that's 3. Premium. And I guess what happens is that let's see, call and a put, strike price, premium, and I'm trying to think of what the 5th one was. Delta. We could throw a Greek in there as delta. That's about it. And those 5 words basically explain options. So in other words, if you learn what a call is, and a call is basically the option that goes up in value when the underlying product goes up in value. Okay. Then there's the put, which goes up in value when a product goes down and loses value. And then there is the strike price, which has like about 3 words connected to it, which is probably the most complicated of them all. And that is, the strike price means when the option itself, what price you can exercise it at, and that's probably what scares people. Now you're getting complicated. So the strike price is the word that's probably the most complicated of all. And so probably what we should do is dissect strike price and then go from there. And so that's basically the gist of it all, is that you're trying to understand what a call is, and it's relatively easy. A call is the option that goes up in value when the option product, the product itself, goes up. The option product, or the option, or we usually call the product. So in other words, if you have calls on the euro, if the euro goes up, then the call option goes up in value. And if you have puts on the euro and the euro is going up, those puts go down in value. And what is it exactly that goes down? The premium. So they refer to the option. So what you buy and sell, when you buy a call, you're buying the premium of the option, the call option. And if you're shorting it, you're selling the premium. And then when you there were 11 people watching, and now we're down to 6. And so, unfortunately, those words terrify people. They scare them to death. They scare you to death. People get terrified. They're like evil. They're like the devil incarnate. They just scare the daylights out of you. They're like the end of times. They're the greatest fear anybody's ever had is the word option. And people go, oh, we got one back. So we're going to work through those and see if we can. Let me see if I can put a flash example up on the screen. Let's see, trading, and then let's see. I should have put this together yesterday, the options. And what I can do is I can show you them live. And that's probably the smarter thing of all. Let's see, right there. I guess that would do it. Let's open that up. We're going to open up an options page. And, or even better yet, maybe I should even do that and just go over to this. There we go. That options page. I was going to open up a new trading platform. And we'll put the euros in there. And let's see. So that would be like 6E. They're going to be the future options. And that would be U0. Enter. See what it does. There they are. Okay. And then what are we doing here? Let's see. Make sure we have everything right. Yeah, like that. And then let me just close that. And now let's put a picture of that up there. Let's see what this looks like. And these are like the most terrifying things on the planet. They scare everybody. Everybody's scared but me. Donka's not scared of them. And so this is the this is the call side, and you can see the little sign up top there. It says calls. These are 56-day-old calls. It says right there, going into November. And so these are the calls, and then over here are the puts. So that's 2 of the words, and then you can see there's a bid on the calls. I'm sorry, that's the puts. There's a bid on the puts, and there's an ask on the puts. So you can buy a put, or you can sell a put. You can sell, and what you're selling is the premium, and that's what you're doing. You're trading the premium of the option. And so, I guess I should literally have a whiteboard and write these things down and put them on the screen. But I think it's better to just look at them, because maybe the more you look at it, you realize that they're not something you have to fear. Like here over on the calls, and we're looking at. Let's look at. You can see at the same time. Euro is trading at 118.46 on you see it in J4X there. Let's see where we could take the mousey and point it out over here. Just running my mouse. Where's my mouse? Oh, mousey. Right there. Right there. You can see the price. There's the euro. And you can see here, there is the calls. And these are the strike prices right there. And so, there's a call strike and a put strike equal. There was always when there's a 114.5, or in this case here with the product trading at 18.5, there's a 118 put over here with a bid and an offer. And there is a call with a bid and an offer. And so you can buy a call, and what you're buying when you buy the call, they call it the premium. So you're bidding on the premium. And if you go to short it, you're shorting the premium. All right, how you doing? You're probably not scared because you are trading on demo. No, I've got 10 or 11 world records on trading. I've traded hundreds of thousands of options in a day. So, and I've been doing it for 40 years. So, I have a lot of experience at it. That would be a very good thing to do, is to trade on the demo. I would suggest that for everybody. That to use that's a good point. RISO. I like that. I'm glad you brought it up. Using a demo would be a very good thing to understand the options better. I think you're right. And so I think that our RISO has brought up a good point, and that is for most of you out there, it would be better to trade, practice these things with the demos, to start off with. That'd be the very positive thing to do. But if you understand what you're looking at, you'll get very comfortable with it, and then go from there. Let's see. Juicy says, "What platform you use for options?" I use a couple of them. It doesn't matter. They're all. One thing I have learned over the years, all the option platforms are the same. They're you can name any one of the brokerage houses. They all pretty much. That's because there's not much of a difference. Now there might be some tools, some extra tools that some offer versus others, but that's not really necessary at the moment. So RI says, RI says, I know that you have experience, otherwise you wouldn't be here. That's nice, thank you. But the plus 500 have very wide spreads. Well, in this case here, let's go look at you want to look at the S&P 500? We can do that. We can go over and look at the S&P 500. Let's see. Oh, there it is right there. All right. So there's the S&P 500. And you can see they emphasize the calls and the puts as it's thinking. And this is going to expire in 5 days, which is, I guess would be Wednesday of next week. And so in this case here, not too bad. When you're incredibly more valuable, then it becomes a little bit tougher. And the markets haven't opened yet. They open up really once the U.S. markets get going. The markets are tighter. But yes, you have to be very careful, especially with the future options versus the equity options. You have to be very careful not to do market orders because you can get in real trouble. Because when they're wide, you can end up buying it way too high. And we can go through that and explain to you how to deal with that. So, Doc, what if I wanted to trade 10-tick trades? There is a broker that offers attractive conditions, and the only handicap is to trade 10 ticks options. Yeah, I imagine so. I mean, there's customization everywhere. In the case of, depending on the product, like the euro, you can see that there are 50 pip wide bids, not bids and offers, but strike prices, and so that can be resolved relatively easy. If you're trying to trade for 10 pips, let's give you a good example. Like we had the euro up there a few seconds ago. Let's go back to that, and then we can answer Rukos Juicy's answer about the S&P 500. We can talk about the width of that. And so let me just go back to the where is it at? 60. Where you are? Why don't I see you? There you are. Whoop. Got the wrong one there. And there it is right there. And so and you can see here with the euro trading at 118.45, these strike prices are monolithic. They're like permanent. So in other words, once they're created, they don't die until they expire. When looking at a strike price, the strike price really represents the strike price itself. It'll also define when it expires. So in other words, if it's a November 118.5 call, it means that it expires in November, and it's a fixed date and time, and that's very important. And so the strike price and expiration, it's all combined together, because when you're looking at a strike price, you're really looking at the price that you can exercise the option. That's the strike price, the exercise, and the exercise or when it dissolves, when it expires. Okay? And so in American options, you can exercise them at any time. In European options, you can exercise those only at expiration. And so those words are the scary words that seems to chase people away. But we're just going to talk about them. And after a while, I hope that everybody here feels a little bit more comfortable about them, since we'll describe them more and more and more. Let's see. What did Juicy ask again? So Juicy's saying basically, it's RI. RI is saying that if I wanted to trade 10 tick trades, and if I wanted to predict the direction only on a short-term basis, tick or minute level. Now that's a good question. You're asking technically, how would you trade for 10 ticks with options? And there's a few ways of doing stuff like that. So in other words, let's take a look and give you a good example. So here is the 117 call, and it is a 246 bid, 252 offered. You would never just bid 252 and just buy it at the offer. You would start off with maybe splitting the middle. 46 to 52 is 6 pips, so you would think 49. So you bid one tick underneath that, 48, and see what happens. See if anybody comes down and offers you. Now you can see here the offers just moved down to 51 from 52, and it's 46 bids. So now it's 5 wide. Someone has decided there's 30 of them offered at 51 at the moment. And so that is the way to start to move into the product. Now RI is asking, how do you decide if it's going to go 10 ticks? And so we use our technical analysis, our quantitative analysis, to decide when it's going to make a move. But there's a few other things too that can be insightful. That this may sound odd, but when looking at a product, one of the first things you want to do is you want to look at the option, the call and put at the same price. So in this case here, the put right there with the, and let's go to 26 days like that. The put, the 18.5 put, let's highlight it too. Matter of fact, look at that. They've got 1825s, 118s, 117.75s. They've got this thing in 25 pips. They must add those as it gets close to expiration. And so in this case here, whenever you're looking at, no matter what product it is, the first thing you should do when you're looking at a option chain, that's what they call this whole thing, is an option chain. And that, what you do is you see where Dukascopy has it at 1836, offered at 1837. It's basically dropped about 9-10 pips. So then what happens is that you look at, let's say we'll look at the 118.25 call and put. So right there, it's 113 at 17. So you just split it down the middle. Say it's a 115 or 116 value. Take 116, add it to the put, which is 76 at 80 right there. I'm highlighting them. That's 78. So you add 78 to say 116. Okay. And so that is 194. Okay, so you have, now what that says basically is that the traders believe that between now and the next 28 days that this product will not go beyond basically 194 pips. Now, when Doc was watching the crazy Brexits, there were times where I would show traders, they were saying, like, where do you think the British pound's going? And I go, I think it can go down like 1,400 points over the next, 6 days. And they were like, are you crazy? 1,400 pips? And then I would go and show them that the strike price at that moment in time of the call and the put were trading at like 1,400 pips and better. And so that gave you a hint at what was going on. You see, RI says, do you trade binary options at Dukascopy? I did the simulations there. I haven't done a live trade. I mean, real options at Dukascopy with the binaries because I was doing the simulations in the contest. But they all work the same. So I don't have any doubts about their ability to offer them. So I think they're good products. But I really do believe that the binaries are more designed for a very short period of time, like an intraday trade. And so you really want to have, you know, a couple of points in space to understand where a product might be able to go at a specific time. Because remember, you're not buying. I mean, you could buy a 24-hour binary. But I really think that the key really to binary options is using them against fundamental news that will possibly move the markets. And now they have a 3-minute limit. When I first started doing the simulations, they were 1 minute and so forth. So now they're down to 3 minutes because people obviously started to pay attention to what I was saying. Is that the 1 minute ones open the doorway for you to put them on and do it going into financial news, and it lowers their success rate of if you have to sell those. So I've noticed that they put a 3-minute limit on there to try to make it more hedgeable, and that's what it really comes down to, is that the brokerage houses need to do things to keep things more hedgeable, and so they don't get in too much financial trouble because they're trying to facilitate execution more than make markets. So I find the binaries a good tool though, but only when you can find a fixed point in space. In other words, 8:30 Eastern Standard Time U.S. There's a lot of financial news that comes out. I think it's like 4:30 EST. About 4 hours earlier. In Europe, you get a lot of financial news. You would want to do that with the binaries because of that. So now RI is still, and we'll go back to Juicy too about the premium width and so forth. But to still answer Juicy's or the RI's point, and that is that how do you choose an option? Now look at that. The bids and offers are disappearing. Maybe there's some news now. How do you choose to try to trade that 10 pip move? Well, obviously, if you're following, let's go back over to here now. So let's look at, let's go back to the fundamental chart for a moment. And in a case like here, we can use a good example is we can look at the intraday movement of the S&P 500 at the moment. So let's put that up on Dukascopy. J4X. Let's see, right there. Now, and then we'll put the S&P options up there. And this way we can answer both RI and Juicy at the same time. So let's see. So RI says, so indeed, and mathematically you would need at least a long-term accuracy of 53% or to be profitable at a payout of 90. Okay. That sounds good. Appreciate the math there. Let's see. What am I looking for here? Oh, yes. Yeah, so what RI was saying is, how do you get 10 ticks out of one of these things? Well, we can look at, in this case here, we can look at, this is the daily. And then we go over to here and we take a look at the intraday. Let's see if we can find one of them. There, it's right there. We'll blow that up. And what you have here is the product over the last, what is that? That's the last 17 minutes. The product has gone basically from 373 almost. It's 372.75. Over the last 15 minutes, it's basically dropped down to 1352. So it dropped, basically 21 points. Okay. Now, if you were using a binary, you could have bought the call and the put and taken a look and see, if it would step out of its range. In this case here, I guess if we can go find the 1 minute, let's see if we can find that. Or not the 1 minute, the 1 day. Let's see what that does. Not there. So we go like that. Let's see if that does. Not there. I'm trying to find just options that will expire today. And so we need to look at those prices. Let's see what happens when I go like that and remove that. There we are. Not there. Let's see. A1 maybe? Let's try that. Not there. These things always confuse me, honestly. The labels. 2A. Let's see what 2A does. There's 3 days. What we want is we want to find the option that expires today, and then we can figure out the binary price. So what did I put in there? 2A? I put in there 2A. Let's see. So I thought I tried 1A. Let's see what 1C does. That's 5. And then 2A gives us 3 days. So that's expiring on Friday. Let's see, maybe another A. I tried that A before. It didn't do anything. It doesn't do that. That's why I say it kind of confuses me. And then I tried 4A. Let's see. I guess if I go there, but it's going to wipe out everything there. Let's see what happens. That's 24 days. Nope, that didn't help any. And then, let's see. Let's just fill them all in. See what happens. There's 19 days. That's not working too well, is it? There we go. Don't ask me what I did, but there it is. This expires today. So now, in the case of the news is already out, it would have been better to obviously look at that when the product was trading at 370. Was it 370? Yeah, 370. Because now it's trading at, where's it at? 355, basically, 356 right here. Right there. So they're quoting it at 48, basically 48 to 49, and the puts are 57 to 58. So we're looking at, they're saying that today this has the potential to go 105 points, which is a big number. 105 points. That's 1,000 points on the Dow Jones Industrial Average. Now, when looking at that, so 100 points, you're basically, you know, when you're looking at SPYs, it's 10 full points. And so what you're doing there is you're trying to figure out the price. How do you buy something for 100 points, the call and the put, and expect it to go up and down 100 points? That's what they think it could happen by the end of today. Up or down 100 points, which is a phenomenal number. Phenomenal. Just phenomenal. Right there. So if we looked at it when it was at 75 and you bought the puts, now you have to be opinionated because the bid, not the bid, but the price of the straddle is so high that you can't use that to measure the news that was coming out at, and there must have been news at 8:30, you know, right before just as the webinar was starting. So let's go take a look at what the news possibly was. Let's see. U.S. consumer prices accelerate in August, and that's what knocked the stock market down. So it moved 20 pips. If you now let's take a look at technical analysis again. In other words, if you're watching like my type of work, in this case here, when it was trading at, I guess where would it be? 8:30 would be. Let's see, where are we at? This it's Chicago time on this thing here. So 8:30. So that would be right here. Let's see if we can find it. Right here was when the news came out. Where is it at? Right there, basically right there on that bar. That is, it says 33. So on this bar here, by the close of this bar, so it was at basically 65 at the start of that bar. It traded down to 51. So it went basically 13 handles. And so let's look at, now this is the answer. What you're wondering what I'm answering is, this is the answer for RI. How do you trade 10 ticks? Okay. Well, if you're following a math like mine, it's telling you to be short at 65. Okay, right there. You can see it right there at the close of that bar, because our technical analysis is telling us that it wants to go down in value. And let's make that a little bit thicker. And so there we are. So with this closing underneath here, you would have been short. So let's say you would have bought at that point, the 60 put. Okay. Now the 60 put right now is at 59 at 60. All right. But it dropped 8 points. So let's look at the 70 put right now. And the 70 put is 64 at 65. All right. So if you had bought the 70 put when it was there, that would have been 5 handles, which is more than 10 pips. You know, in other words, it ticks in four. Each handle is 4 ticks. So you're looking basically at 2.5 points. You're looking off to make a 10-tick win. Does that make any sense to you there? I do. I use a tick chart. Oh no, I think this is a contract chart. I'm using a 3,600 contract chart. Yeah, 3,600 contracts. It changes. I use tick charts on some things. I use contract charts on others. So if you're shooting for 10 ticks and you were following a technical analysis like ours, you know, something like ours, it would have told you to be short at 65 or 63, I guess in this case here, 62. And so you would have bought the 60 put, which now you can look at the price of the 70 and you see it's 65 at 66, which is going to Juicy's opinion, and it's wide. The reason why it was wide is because news was coming out and they want to not get trapped with anything particular. So they're keeping them a full handle. When the U.S. market opens up, chances are it'll be at 65 at 65 and a half, and you can actually buy it at, you know, a quarter pip. Right now they're offering it at 3/4 of a pip wide. In this case here, you would have made easily your 10 ticks that you're looking to make. Now, obviously, if it went the wrong way, you have the potential, obviously, to lose money, because if you're buying a put, puts make money when the product goes down. And if you thought that the news that was coming out was going to be bearish, or you're following a technical analysis that shows you the direction, you know, like 8.5 times out of 10, then you are risking, I guess, every couple trades, you know, somewhere along the line, you're going to have a loss. But most of the time, you're going to have a win. And you can have a stop order out there to not, you can put your classic stop out there to sell it if the price is touched, you know, 10 ticks down or 15 ticks down or something of that nature. And at the same time, you're shooting for 10 ticks. Does that all make sense to you? Trying as I described that? I just want to make sure you understand that. And so we go back to the 5 words: call, put, strike price, exercise, and premium. Okay? And the call represents 2 different concepts. Obviously, you can buy the premium of a call. You can sell the premium of a call. You can sell it short. Same thing with a put. You can buy the premium. You can sell the premium short. And obviously, when you're selling, let's see, what's this? Let's see. Well, it depends on the volatility. If I would have made the 10 ticks, well, you know, on a very short-term thing, no, because you know you're at the money, and so if it goes down, it's going to make money. Now, obviously, if you buy some cheap option with not much action in it, delta, then volatility or anything like that, if you don't really get a big move out of it, then it's not going to go anywhere. That's why if you're going to trade for 10 ticks, you got to trade with something that has a delta of at least 50, 60, something like that, 45, 50, right around in there. You need something that has some value to it. And so the volatility in the first few minutes is not going to disappear on you. That will influence those 10 ticks. If anything, the volatility would normally move in your favor, because as the first minute or two of action, the volatility is going to be higher, not lower. Volatility really is more important for people who trade options against other products, and they're in there for days and weeks. And so you kind of want to try to buy low volatility, sell higher volatility. Volatility will represent if a product has extreme noise coming at it, like financial news or product development that's going to be released. That's more of what's going to kick around the volatility. But volatility, if you're just intraday trading, you don't really have to worry about the volatility, because if you're really intraday trading, you're going to trade something with a delta, of a higher percentage, like 50, 60%. So it means that it moves. If it goes down $1 or a full handle, you're going to make 60 cents of it. That's what the delta really means. And if it goes down another bunch of points and it has a 70 delta to it, that means it's going to make 70% of that dollar. That's what it's going to do. And so if you're intraday trading, the volatility is not that important. Now I was a volatility trader for years. Traded volatility. I mean, like, you become enamored with the volatility of the back months and the front months. You can see it here on. Let's put that screen back up again. In this case here, you can see it on the option chain. There's your volatilities right there. And so these are the call volatilities on this side. These are the put volatilities on that side. And so the more valuable an option, it's going to react better for you as an intraday trade. Capiche? So that one word out of the 5, or I guess it's a combination of it. It's exercise price, the strike price, the exercise price, and the date that it expires. That tells you, where you can exercise the product, and that means calling something away or putting to somebody. And so that's where we really are, is that middle one. The call and the put is not that really hard for people to grasp. Calls go up in value when the underlying product goes up in value, and puts go down in value when it's going up in value, and vice versa. If it's the underlying product, like the euro or the S&P, are going down in value, then what happens is the calls lose money in value. The premium does. It disappears more. It becomes less. And the put premium goes up in value. How's that? Pretty good stuff or what? Everybody feel a little comfortable with that? I mean, it's a simple concept. And if you think about it, and have it written down on a sticky note or something like that, that's always helpful. Now, again, the third word, strike price, represents a lot, because the strike price is telling you when an option expires, what price you can exercise it at, and when it expires, and the exercise price. That's pretty much what it comes down to. So in other words, if you have a 118.5 put, and with the product now trading at, where's the euro at? Let's put the euro back in there again. right there. So it's bounced back up from 36 up to 50 again, or 49 and a half. So, if you were going to trade that down, we put a tick chart up and watch how that trades and follow a technical analysis. And so that's pretty much the best way to play this. And have, if you use good money management skills, use a stop to get out of these things. Say it has to, tick at this price and sell it for one tick below that price. Not necessarily a market order and sending it, giving up even more pips. Chances are you'll do all right. And so that is how to understand the 5 words. And then again, the third word, strike price, usually means more than just strike price itself. It'll also say what its exercise date is. And so that'll tell you how much premium is going to be in it, because it's a cost to carry thing. And so, and then the premium itself is what you trade, and that's how you're looking at the volatility. So in other words, if volatility increases, you're going to find that options become more expensive. The premium does. And that's what you're buying. You're buying the call premium and you're shorting the call premium if you're selling it short. And vice versa. You're buying the put premium and shorting the put premium if you choose to through your technical analysis. And so that is where we are with this whole thing. I hope that's helpful. Now, what we're going to do is we're going to take a look at the charts. It's Friday. See what everybody's doing. And if you have any option questions, you can fire them out. But at least we gave a good half hour of it, and I don't want to torture you over it, because again, it's a very concerning concept of trading. To me, it's the 21st century. It's, in the later part of the 20th century, options became listed, and it changed the complexion of the marketplace. And so, as a young guy at the New York Stock Exchange, the old guys used to bitch about them all the time. You option guys messed up the market. Stocks would trade, 30 and 40 cents a year. Now they're going up and down 30 and 40 cents in a day. They used to hate that. All right. Let's see, where are we at here? Let's go back to the charts. We're going to take a look. Like I said, it's Friday, so we're going to just take a quick peek at all the products. And to start off with, let's see where we are with the euro. And again, if you have an option question, just fire it out. That's fine. If not, we'll take a look at it again. I think we're gonna do this a couple days a week. I think we're gonna label this as the 5 option words that scare everybody, and I think it's a good thing. The more we talk about them, people will get to understand what they are and realize that there's literally a fixed number of issues. Now you can, like I said, like R.I. said, volatility and so forth. Excuse me. You can get into the Greeks. You can get into the inner workings, but they don't really, it's not that necessary if you're going to try to intraday trade or even just long-term trade, because there are ways of dealing with that volatility and decay. And so we can show you that concept, how to do it. It's relatively easy. It's just spread trading. So, all right. That's probably another scary word, right? Spreads. There you go. Let's go back, and then I usually do my tirade about the guys who named options, because now you have straps, straddles, and strangles. And straddles. Did I say straddles? I said strangles, didn't I? Straps, straddles, and strangles. I mean, it sounds like they were into S&M. So no wonder a lot of people were scared of it. It's like, whoa, I'm here for pleasure. I'm not here for pain. All right. So let's take a look at the euro, and we'll take a look at it also through our work here. And there is the euro. You can see it's holding up. It's bounced back up. We're through the daily buy. It gave us a red and green yesterday, and so today it's cleanly up there. So it's through the buy number. Looking good. It did do there. It closed in the buy, but we have a red and a green, and that red and green stops you from getting long on the close, and allows you to get long a couple hours later, off of the opening opening ranges. Long as the math is pointing back up, you're welcome to get long because we're in a weekly buy, and sure enough, you can see how the body of the candle is up, up and away, just like it is right there. You can see J4X is moving up, and you can see our work. They played with the weekly and then came back above it. So obviously it has a desire to go up in value, not down in value. And so when we look at our fact check spreadsheet, Excel spreadsheet there, line 14, we're 16 weeks in a buy and 7 days in a sell. So we've been in a sell since up in here, and now it is trying to tell you that the trend has changed, and you can be long, especially with the weekly in a buy. And sure enough, it's going up in value. All right, now let's take a look at cable, because last I saw cable, and that was more like yesterday. I didn't really look at it that close this morning. You can see the cable is flirting with its weekly sell, and it's been in a sell for, and that's line 13, 6 days right there. I'll highlight both of them like that. So cable's been in a weekly buy for 8 weeks, and it looks like it's going to go into the weekly sell. We'll see what that brings to it all. And I guess that's because there's another Brexit thing coming around the corner. Who knows? There's always something driving everybody crazy with this stuff, especially the political side of it all. All right. Now, let's see. That's the cable. Let's take a look at Turkish lira. We're just going to run through the ones we normally do. Unless someone wants to see something, and then I'll stop what I'm doing and we'll go look at it. So here, what we have is the Turkish lira. And we go over to the spreadsheet, and that's line 17. Right there. Which is horrendously crazy. 40 weeks now in a weekly buy. Let's just put it on. It's been in a buy since December of last year at this point. Let's put it up on J4X. That is wild, I mean, that is really wild. And it went into the daily sell yesterday, I believe. You can see it right there. We closed down below, and it still is down there. But this thing does not like to stay down. You can see it's lifting up, and we still have red dots, and we're below. But look at the weekly. The weekly has no interest whatsoever to go near the sell. So maybe it'll sell this down again towards the end of the day. And the all-time highs are like 49 and change. So that's no more than 2 days ago. Yesterday was 48.50 something, and the day before was 49. What was that? 49.89. So as I take a bite out of the apple here, and it's going to be 41 weeks. And this thing has been in a buy way back here in December, way down in the 570s. All right, now let's go over to Canadian. Oh, don't do that. Let's just go like that. There we are. There's Canadian. You can see it's flirting with its daily sell. We got a green dot though, but it is doing it. And Canadian on the spreadsheet is line 20, and we're 6 days in the daily buy and 8 weeks in a sell. So the daily kept you out of this move up, which is great because, the weekly's telling us that it wants to go down in value. No questions there, I see. I'm just going to refresh my chat line just in case. No questions. I think it's a TJIF, and it's September 11th at the same time. People were... the second building, I think, has been hit now. I think that's where we're at. The second building has been hit. Freak out city. At that point, the traders from the 94 bombing, unfortunately, got a bad habit of just going to smoke in the hallway, in the stairwells. So, unfortunately, people died that way because when they bombed it last time. All right, not counting the ones who were trapped, which I haven't a text or two about people dying, like we're dying all here, things like that. All right, now let's see, where am I going at? Let's take a look at the Swiss. Oh no, yes. Did we? No, I say we're doing the Canadian, and so let's take a look at the Canadian. You see it here. That's the Canadian, and you can see it here on J4X. And as you can see on line 20 of our fact check spreadsheet there on the left, it's 8 weeks in a sell and 6 days in a buy. And you can see our work is trying to head down. So that pressure is on. Okay. Let's see. There we go. Anyway, there we are with the Canadian, and it's just drifting down, and you can see the weekly is not making any attempt to really get into the buy. It won't even break the time manifold at the moment. Right there. And you can see here on the J4X, it's trying to be a little firm in here. And over our stuff, you can see it's just down a little bit for the day. All right, now we'll jump over to Swiss and see what the Swiss is up to. That's line 21. 15 weeks in a sell, 2 days in a sell. We'll put that up on the J4X right there. You can see there's still a little pressure going on. And we've been in sell for, what is that? 15 weeks. So all of August, all of July, there's 8 weeks right there. 9 weeks this week, 10 maybe. Almost all of June, maybe even April. Let's see what it is over here. So the product has been in a sell since right there. What's that? May 29th, the week of the close of May 29th. When you scrunch it all up, obviously our fact check spreadsheet does a good job of tracking that. That's what that's all about. See right there. And that's why we do that. We have, oh, yellowfish. Would be interesting to look at Bitcoin since that will be trading over the weekend. Let's take a look at it. Right there. There's a September contract. Did that island top thing we were talking about up in here. You can see it's trying to move back down in the sell. Down here on the spreadsheet, where is it at? Right there. It's down at the very, very bottom. 3 weeks in a sell, 3 days in a sell. Let's put it up on J4X. There we go. You see 3 weeks in a sell. It's obviously been going down for a while. Somewhere's up in here. Confirmed the weekly sell right there. Somewhere's around here. Went to a daily sell there a couple days before it. And was in a sell all the way up until just recently right there. This one, because it went plus, but the problem is that we had a red dot, so you couldn't take it until the next day. And you can see what happened the next day. It gapped down, so it worked out all right. And so it was a good short, being short the daily and the weekly at the combined together. You can see it bounced here, telling us that it was trying to turn up. And it did. It moved up. It went from, what is that? A close of $10,030 with a low of $9,925. And ran as high as $10,565. That's the high. And the close of $10,365. Now we're flirting with the sell again. But you can see here, we're not doing anything to get into the weekly buy. So you can see it's down in here still. See, Yellowfish says that's a question. There's a question Are option markets open for cryptos on Saturdays and Sundays? Unfortunately, not. Good question, but no. At least not the futures contract. Dukascopy might have something going, and I think I have heard that there are some markets for them, but I've been thinking about getting a new data source because I understand bar charts could feed my system. They have a lot of cryptos. So that's where we are with that one. But no, I don't. Not the listed market. The listed market is closed. The futures market, that is. They close it, and it doesn't open up again until Sunday evening. And even then, the markets might be a little wide in there until the U.S. market fully opens on Monday morning. All right. Let's see. What's the next product? We got about a minute and a half, so we can still do something here. And the answer to that is, let's see. Let's take a look at the Nasdaq 100. It's been in a weekly buy. Where's it at? Right there. 22 weeks. It's probably like the second longest product we have in a buy. Gold was 22. Is also 22 weeks. We take a look at both of those. So first, let's take a look at. Let's see. Right. Let's see. Where is it at? Right there. So there's Nasdaq. You can see Nasdaq is fighting to stay in the weekly buy here. It's been vacillating back and forth. You see the histogram is minus, but the white line is plus. You see daily's been in a sell for, since up in here. Let's see. Then what was the other one? Gold. Gold's 22 weeks. And you can see here that it looks like it's going to push itself into the sell. Right there. Looks like we're going to see gold go into a weekly sell. Silver went into a weekly sell last week. Excuse me. Let's take a look at that. Yeah, see it up in here. And it hasn't really done anything too exciting. It was in a sell. And it went down a day and it just flipped right back again. I guess that's Monday. Now there's Monday right there. So it made a new low, like a 10-day low on the short of it, and then obviously it ripped its way right back up again. By the end of the day, it was telling you to try to cover yourself, and you can see it's really made a nice move up, but we're in a weekly sell, so you can't trade the long side there. And now it looks like we're going to see gold go into a weekly sell too at the same time. So alrighty, everybody have a safe and smart weekend. We will catch you all on the flip side Monday. And so this is Doc from North America. Have a safe and smart weekend. As the singing trader would say, is happy trails to you until we meet again. Happy trails to you, to all our trading friends.